The Get Rich Slow Club podcast is a collaboration between Tash Etchman from Tash Invest and Anna Christina from Perla. The Get Rich Slow Club acknowledges the traditional custodians of the land we record on. From coast to coast, across land, waters, and communities, we pay our respects to elders past, present, and emerging. Any advice is general and does not consider your financial situation, needs, or objectives, so consider whether it's appropriate for you.
Welcome to the Get Rich Slow Club podcast, where we take you from beginner to confident investor,
where we can teach you everything you need to know about investing.
So come get rich slow with us.
Hello and welcome back. I'm here with Ben Nash from Pivot Wealth. You've probably seen him around on TikTok. Are you Australia's most followed financial advisor, I've read?
I am.
Amazing. Very impressive. What do you do? You're a financial advisor?
I'm a financial advisor. I also do the occasional TikTok.
And you have a few books as well.
Write some books, yes. My third book, Virgin Millionaire, is coming out in September, so that's pretty exciting. I'm pumped to do that. But yeah, look, I started my financial advice business in 2015. Pivot Wealth started, just as myself as the advisor. I sort of brought my wife into working with me, and we worked together for a bit. And I just really liked marketing and content stuff. And so I started doing some talks through the business, mainly as a way to, generate some exposure for the business. And sort of just like one thing led to another thing. And as the business has grown, my role has transitioned more to that, I suppose, marketing and brand awareness piece. And so these days, the majority of my time is doing stuff like having conversations like this and putting together content for our clients and the broader audience as well.
I've always wondered how you do it all, because I find making content so time consuming. So seeing you make heaps of content and do a podcast and write books, but also running a business seems very impressive.
Yeah, thank you. I appreciate that. It is a bit, but I like to systemize my stuff. And so I, start doing it in a way, and then I just try to get a little bit better, a little bit faster over time. And so it's actually it's most of my time, but you can get a lot done in a short amount of time if you batch your activities, I find.
Do you batch create content?
Yeah, 100%.
Oh, interesting.
Yeah, so I just have like a big doc that I put all of my ideas into, and then I'll just record 5 or 6 at a time. And then I just make sure that I do it in different spots. So so I've got a different background, and then it's like my drafts is just filled with 30 pieces of content, and then I just make sure that I post them out where I'm wearing different hats.
Amazing. Different t-shirts, yeah.
Exactly.
I wear too much of the same stuff sometimes. It'll be like I'm wearing the same black top over and over again, but I've got like 4 of them or something. Yeah.
Yeah, well, that's the problem with wearing like my Pivot Wealth tops, which is what I wear most of the time in the office, that they do look the same. But different background is the key, not the same seat, Tash.
Park your car in a different spot every time.
Exactly.
Nice. We're actually going to talk about property in a little bit and REITs, real estate investment trusts, because I get a few questions about that. But first, do you have a money win or money loss for us?
I do. I've got a money loss. I recently lost about 30 grand on Bitcoin, but probably not in the way that you would think.
Yeah.
So I had some Bitcoin in my super fund. Don't judge me, please. It's been in there for a long time. And it had gone up quite a lot in value. Like obviously Bitcoin has kicked off over the last little while. When it got to the new financial year, I wanted to transition my Bitcoin from owning it on a crypto platform to owning it on the new ETF, which is listed, on the ASX.
Interesting.
And so
why?
Security, I suppose, peace of mind is probably the biggest thing. That these platforms, you see FTX and, all of the stuff that came along with that. I'm not smart enough to figure out how to do all of the storage stuff.
Put it on a hard wallet. Yeah, I couldn't do that either. I just lose it.
Also, that just makes me so nervous. Yeah, like what if something happens, and then all of the stuff, and I'm like, look, it's 0.5%. I'm just going to pay the fee. They'll look after it. I don't have to stress about it. And then it can go into a normal investment account, which makes me feel better because it's all together anyway.
Yeah.
And so the Bitcoin price has been running, but then it sort of cooled in July, and I thought, well, this is my opportunity. I can sell it while it's down. Means that my capital gain isn't going to be as high, because it's going to be a capital gain when I'm selling from the pure Bitcoin and putting it into the ETF. Sold it, lower gain, sold it like 85K was the AUD price at that point in time. Then had to wait for the cash. The cash came quickly, but then I had to get it into the account. Then I went to trade it. Went to trade on this platform, which I will not name, but it's a platform that I now am not happy with at all.
No.
For some reason, they don't offer the Australian Bitcoin ETF on their platform, but also don't make it clear that they don't offer. So I got the cash, put it into the account, went to trade, couldn't trade. Okay, shit, this is bad. Go to take the money out. Money locked up for 3 business days, even though I just put it in. Wait to get the money back out 3 business days. In the meantime, watching the Bitcoin price, and it's just going 90K, 95K, 100K, 105K. It was not a fun time.
Stressful.
And then by the time I got it out and back in, there was a little bit more of a correction. I was agonizing. This is why I don't try to time the market. This is why all of my investments are on autopilot, because like just whether the market's up or whether the market's down, it's like if the market's down, I feel a bit good. If the market's up, I feel a bit good. Like it's just getting invested. And so I got the money in. Ended up buying the bullet. 30K was the price that I paid in the end.
Oh, wow. So many lessons from that. One, check the platform actually has what you want. Interesting that they don't. Very interesting, but definitely go and search first.
Well, I think that because the Bitcoin ETF is new, that they're still getting around the regulation. Like I know that even on the platform that I ended up buying it through, that it was like a real tiz, and I had to be talking to them directly and doing it in certain parcel sizes and all of this sort of stuff. So I think they're still figuring it out. But
was it worth it? For the hassle and not losing the 30 grand, but was it worth it just to have it together after all of the, like if you hadn't have lost 30 grand, would it have been worth it to just have it together, even though the admin nightmare?
Oh, I think definitely. I think it's definitely good to put it all in one place, easier to do. 30 grand, that would have been good.
Yeah, that's so hard. Yeah, things can be so just, I hate that. One of my brokers didn't put my middle name on, but my share registries have my middle name. Yeah. So that's been an absolute nightmare trying to get them to realize that it's still me, even though everything's still the exact same. I have to go and like physically print something and then go get it, notarized or something.
Yeah. The share registries are so like archaic in terms of all of the stuff. I recently did some things that I had some dividend checks that got mailed out to me, which of course I didn't cash. Yeah. And then my accountants were going, well, you got this dividend check. It hasn't been there. I figured out that you can actually get it released into your bank account, but then I had to go to all these systems and do these forms and stuff. It's like you see why the investment apps exist, like to just make it easy and make it simple, and what the hell? Yeah.
Fun. That was a really good one. We haven't had an interesting one like that for a while. So good.
Well, yes, I'm happy to help, Tash.
Back into property. Property prices are really expensive at the moment, and it's quite hard for people to buy property straight out. What are real estate investment trusts, and are they worth buying?
So a real estate investment trust is pretty much like an ETF in some ways, but for property as opposed to for shares. So pretty much most real estate, REIT means real estate investment trust. They just get a big pile of money together, go buy a bunch of different properties. Commonly, it's commercial property, so often office buildings and skyscrapers and all of that sort of jazz. And then they just bundle it up sort of like a managed fund and sell units in the managed fund to investors. And so for an investor, you can invest $100 or generally smaller parcels, but you're getting pieces of property in a bigger property essentially.
Yeah, in a bigger parcel. Why would someone buy it then? Is it actually worth buying it? Like personally, I've just looked at it. I've never liked listed investment companies, LICs that people used to buy. I just feel like I don't really want to bother with that. I like ETFs instead. I kind of looked at real estate investment trusts like the same, just like, no, can't be bothered with it. Yeah. Is that wrong? Should I be looking at them?
Look, I think that real estate investment trusts give you exposure to property, and having a diversified approach to your investments is something that's generally a pretty good idea. It's a way that you can spread out your risk and reduce it. But it depends on what your strategy is. Like if you've already got, and obviously all of your stuff is sort of public, that you've got investment properties, you've got an investment property, it's like that can be your property exposure. But if you were someone and say you don't have an investment property, or you weren't intending to buy an investment property and you wanted to build a nice diversified investment portfolio, you might put some Australian shares, some US shares, some international shares, and maybe some REITs alongside it, so that you've got that property exposure as well. I do think though that you probably, if you're thinking about going into REITs, that you just want to be careful with, making sure you got managers that have a good track record, that they've got quality underlying assets and all of those sorts of things, because commercial property, it can be quite volatile. It's quite tightly linked to the economic cycle. And because with these REITs that they're generally investing fairly substantial amounts of money, they're not buying, $500,000 apartments. They're buying $50 million skyscrapers and stuff. And so, and they tend to fluctuate in value more, particularly when you're seeing rising interest rates or, positive or negative movements in the economy.
I've seen they don't generally perform. I don't know if it's all of them, but the ones I've looked at quickly don't seem to perform that well in comparison to shares. Is that something you see as well, or do they generally perform fine?
Well, it depends on what the underlying asset actually is. And so it's probably quite different to shares in that you've got these property funds with different mandates. And as you said, like some of them will buy up shopping centres, some of them buy premium office buildings, some of them might buy more regional office buildings, or, there's probably a million different variations in between. And so it's not like when you're buying, it's not like you're choosing between index funds where everything is pretty much the same. You're choosing between vastly different investment options. I would say that at the moment, these funds are probably not doing particularly well because interest rates are quite high. Office occupancy is low in relative terms. And
people working from home.
There's all of that sort of stuff. And so that obviously flows through to the impact. And I think that you like one of the really early lessons that I learned with my money is actually I bought some shares in Centro Property Group in the GFC basically in 2008. And they basically got burnt by the fact that with these shares that they have and with the REITs, it's the same, that they're backed, and LICs is the same as well, the listed investment companies, that you've got a net tangible asset backing underneath. So it's like you could have all of these units in a REIT fund that are valued at $100 million, say, which means that if you wanted to buy them all, you need to pay $100 million. Then it's got underlying investments inside it. And generally you'd want to see those two, like the price that you would need to pay and the value of the underlying investment should be fairly closely correlated. But when it comes to commercial buildings, it's not a liquid market for commercial buildings. And so if there was an economic shock, then like overnight tonight, then the value of a commercial building tomorrow might be significantly different to what it is today. And so those valuations can change quite quickly. And so I saw that the value of Centro shares was way lower than the net tangible asset backing. And I was like, this is amazing. This company is actually on sale for less than the value of the assets that it's worth. It was like 1.3 times or something. So I'm like, I'm going to load up on these shares. And when I say load up, I was a poor uni student. And so I think I bought $500 worth or $1,000 worth or something.
Loaded now,
but then they immediately wrote down the value, like all of the net tangible, like the underlying asset values. So it was then like 0.4 or something. And then the company went bust after that. So I think you want to be careful. Obviously, that's a pretty extreme example, but when it comes to these REITs, you want a company that's got a good track record, long-term history, reliable, but not just performance, but just consistency in, things like how it's valuing its assets and what the performance ultimately is. Yeah,
that's a really good point that I haven't really thought too much about. Are there ones that you would not recommend, but are there some popular ones that people can start looking into?
I actually don't recommend a lot of REITs to our clients, so I'm probably not the best one to advise on that, because for our clients, a lot of them already own property or are planning to buy property. And so we typically do not recommend like additional exposure to REITs, because our clients generally tend to be probably a little bit overexposed to property.
Yeah, interesting.
Yeah.
How do you balance that? I get that question all the time of like, how do I pick between shares and property? How do you generally advise people to go about that?
Well, property tends to win because of the power of leverage. Because when you buy a property, you might save up $100,000 and you're not going, you go borrow $500,000 and then you got a $600,000 property. When you buy $100,000 worth of shares, you save up your $100,000 and you buy $100,000 worth of shares. And so if you've got good property and good shares, the property will always win because it's 5 times the size.
I found that recently. It's been a bit sad, but I've put like $200,000 of my own money into shares and it's grown by like $40,000, which is still great. But then my apartment has grown by like $150,000 and I put down a $50,000 deposit, for example. Yeah. So that's been interesting to watch that play out.
Yeah, well, it's just the power of leverage, and so that's why it does tend to win. But obviously, the more borrowing you have, the more risk you have in your strategy as well, and the more you borrow, the worse your cash flow is going to be as well. And so, when we're helping clients with their financial planning, the core of what we do is that we use financial modeling or financial planning software where we pretty much go, okay, well, this is your income, this is how much you're spending, this is what all your assets are. If you do exactly what you're doing today, this is where you're going to be in, a month, 6 months, a year, 6 years, whatever. Then if you crank a share portfolio, this is what it means. This is what the impact is. If you crank a property, like you buy a property, buy 2 properties, this is what it looks like. And so the best strategy, I always know what the best strategy is going to be before we do it though, which is borrow as much money as the banks will possibly lend you and then go and load up into property. Like that's always the winning strategy because maths is maths, right? Yeah. That's just how maths works. And so, but when you play that out, like that's not going to be the best strategy for most people because if you're doing that, then you're not going to be able to sleep at night. Your cash flow is going to suck because you're going to have to make all of these debt repayments. Your risk management is going to be all out of whack, right? But if you live your whole life and you don't borrow any money and you don't buy any property, then you're probably going to be leaving a lot of money on the table, like in terms of your financial potential, because you could have some borrowing and manage your risk well and, do all of those things. So what that means is that for everyone, there's somewhere between no leverage and maximum leverage, which is the right amount of leverage for you. And that's like finding that spot is a super valuable thing. It's not so much a numbers-based thing. It's partly about how do you feel about stuff thing. Like how do you feel about risk? How do you feel about borrowing? How do you feel about being a landlord? All those sorts of things.
We won't dive into that one just yet. Yeah, it's been interesting watching my mum and dad because my dad is a lot more likes to take risks and my mum is very risk averse and her ideal situation would be to buy a property, pay it off and then maybe buy another one. Whereas dad's like, no, we'll just get more loans. Like, why would you pay it off? And it's been interesting watching them have that conversation and seeing that
Who's winning?
Out. They've kind of met in the middle. It was dad for a little while, but now they've sold one to pay off most of their mortgages. So it's kind of, gone back to mum now. But it's just watching those conversations and seeing that not everyone thinks the same. And we were writing out, because I was helping him for a while, like try and explain it to her because she was just like, oh, debt is bad. We were trying to write out a diagram explaining how it all worked. And she just was like, no, like still no. Like the spreadsheet answer versus the mental answer.
I think there's a bit of generational stuff in that. I think that there's also, it was probably a little bit simpler before as well in that you could, like I had a lot of my older family that was their version of money success. Buy a house, pay it off, save money in a bank account.
Good to go.
That's it. And it potentially was enough when you had like a government funded pension that was like significant and perhaps even paying you an income, every year moving forward, that you're probably fine. But these days it's like if you want to replace an income and you want to live in a decent home and you want to pay your mortgage off, it's like your super is not going to be enough. You need to actually be investing, and paying down a mortgage that's really slow.
Yes. Yeah, definitely. I've been trying to work out like how much I've spent in interest versus actual mortgage repayments. And it was like 26,000 or something in interest and 24,000 in actual repayments, which has been fun. But it takes forever to pay it down. So we'll have 30-year mortgages. Yeah,
especially at the start. And so normally it's like if the banks will lend and if your cash flow can handle it, like, and you can manage your risk well, you're generally going to be rewarded for going sooner into more property using more leverage. But there is a limit because you also don't need, you don't need to have 10 properties. You get to a point where, with the right time frame, it's like if you got 2 investment properties or 3 or maybe 4, you would say at the upper limit, it's like you're going to be pretty wealthy in the future. And so then you go, well, while property is great for building your assets, shares are great for living on your assets because the income return on a share portfolio is almost double on average what it is on a property portfolio, depending on the property that you own. But like across the country, the average gross rental yield is 3.71%. And so then you've got to take a rough rule of thumb is like 1% for your ongoing property costs. So you're looking at just under 3% net income on your property. On a share portfolio, on an Australian share portfolio, what would you say?
A lot more. Yeah, it depends what you're getting. But
4.5% is pretty achievable. 5% even if you do position your portfolio specifically for income.
Yeah.
And then you got franking credits as part of that as well. And so you pretty much got double the income on a share portfolio, and the property might be growing more and making you more rich, like on paper. but you also can't live on that value, and you can't just sell a bathroom or a bedroom to go on your next holiday.
I was about to say that. We're all using that example of you can't just sell a bathroom.
Yeah.
I have been a little bit skewed by seeing the Perth rental yields because they've been quite great in the last few years. So yeah, it's definitely a nice reminder that you do need shares for income as well. If someone wants to transition, how do you kind of plan for that? Is it you sell a whole house and put that into shares? Are people building them at the same time? How does that work?
Well, it's obviously I'm biased as a financial planner, but I would say that that's part of the power of a good financial plan. And so I think that ideal state, if you can build your wealth through property and you can afford to continue to fund that property in the future, or you can pay down the debt, or maybe you sell one and you keep the property and you can live on the lower income, then you're going to have asset value that's growing, which is, legacy to give to future generations or people in your family or the causes that you care about or whatever as well. And that's generally apart from the fact that your income is going to be lower, it's going to be a pretty comfortable way to do things because you've still got these assets that are actually growing for you, gives you a lot of wiggle room. Or you could sell it all. At extreme cases, you could sell it all and then crank it all into a nice share portfolio and then maximize your income that way. But sort of like that other example that I was saying with maximum leverage and minimum leverage, it's like the right spot is probably somewhere in the middle. When it gets to that point though, and particularly you're making like hundreds of thousands of dollars, maybe $1 million plus decisions, it's probably worth investing a few bucks and getting a quality financial plan so that you're understanding all of the things that are, that sit around it and make sure that you're making the most of what's there.
Definitely. I think it's important not to focus too much on that now. Like I think a lot of people get quite stuck being like, well, I don't know what I'm going to need at retirement, so I'm not going to bother right now.
Yeah.
But like it doesn't matter if you've got shares or a house, you've still got something that you can use in the future.
Yeah, that's it. And yeah, you may as well go for it, go hard. And then when you get to the future, then you know that you need more.
Help and say, hello, what do I do now?
Or that. Yeah, or someone else.
Yeah.
But I think that for anyone that's struggling to think about how much money do they actually need in the future, it is hard to think about retirement and what that looks like and what sort of lifestyle do you want to live. Like, I don't think you need to get to that level. But the question that you can ask yourself is that in the future, do you feel like, spending at your current level, is that comfortable? Or do you want to be forced to spend less than you are right now? Or do you think you really would need to spend more than you have right now? And so if you use the 5% rule, which says that you can draw an income of 5% from a portfolio of assets without eating into capital, it's like you can sort of work backwards from there. So if your income's $100,000, you divide it by 5%, that means $2 million. Basically, if you had $2 million in your bank account today, you could invest that and get yourself an income of $100,000 a year for the rest of your life. That's like a starting point. Mm-hmm. If you think that you would need more, then obviously your number is higher. If you feel like you're comfortable to have less, then you can start there as well.
Yeah. More is better. Just aim for more.
Being forced to have less it's not a very good strategy, I don't think.
And looking at the super retirement standards, is it like the Australian Super Fund Association or something? Is that what they're called?
ASFA.
Yeah.
I know it's ASFA.
ASFA, that is interesting when they're like, this is a comfortable retirement. And then you have a look at the budgets and they've allocated $7 a week for like fun or whatever it is.
That does not look comfortable to me.
Yeah. And I think the thing a lot of people miss is that they expect you to have a fully paid off home as well for those numbers.
That's right.
Yeah. So it's pretty scary looking at that.
Yes. Yeah. And I think that that's the other part of it, that you do need to have a home and you don't want to have a mortgage on that home in the future. And so think about, how much money you might need for that, where you want to live if you want to move to Cooper Pedy or not.
I have to listen to Ben's podcast to get that reference if it's even in there. Great. Last question. This is more of like a selfish one because I'm thinking about getting a trust for my next property. I've heard the rumors popping up on TikTok and Instagram, and I'm sure a lot of people have seen them as well, that the secret to get around more borrowing capacity is buying in a trust. Is that true, or is it more just for asset protection?
Yes, you can sometimes borrow more when you use the right entities structured in the right ways. And so how that typically works is that generally as an individual, you will have a certain level of borrowing capacity. And so say you could borrow $1 million. If you make that borrowing under a trust or a company or some what you'd call a special purpose vehicle, like a different
special purpose vehicle, that sounds quite wholesome.
Yeah,
like,
there you go. You're special. You're special, Tash.
Yeah.
Very special. But basically, if you borrow money inside another tax entity, like a trust or company, and then you can generally, if you can get that to the point where it's self-sustaining, i.e. the property's neutrally geared, or you put other investments in there. Think like you crank an ETF portfolio inside the trust so that basically it's washing its own face and you aren't required to tip in your own cash flow. Then some lenders will disregard that borrowing essentially. And so you've still got the $1 million borrowing capacity, even though you used it to buy this trust. And so you can then go and have maybe another trust that you generally need to use multiple entities though. So you've got to start to get comfortable with that fact, but you can use multiple. You might be able to borrow with another entity and borrow the $1 million again.
Seems like a bit of a hack. Obviously there's downsides that come with it. When should someone actually consider signing up to a trust or getting a trust? What do you call it? Opening a trust?
Opening a trust.
Opening.
Look, I think if you're considering using a tax entity, I think that there can be significant tax savings on offer there. But you want to make sure that the benefit that you're going to receive is going to be in excess of the costs that you pay. So generally, and it's sort of a little bit like how long is a piece of string, but generally you're going to pay $2,000 to $3,000 at least to open a trust. Then you're going to pay a couple of $1,000s a year to operate a trust, like do the tax returns and all of that sort of stuff as well. And so you want to make sure that you're getting a benefit that's in excess of that. To answer the question a different way, I've seen people use trusts and use them not well, but they might have a $5,000 or $10,000 share portfolio in a trust. And it's like, you can stream some income through a trust, but you're really probably getting $50 of benefit, if that, and then you're paying $1,000 for your tax return. You're ending up behind. Yeah.
I see that with self-managed super funds as well, where people are wanting to put in like 20 grand or something, but it's not worth all the fees that go with it.
Yeah, exactly. So any of those entities, you want to really look closely, what benefit are you going to get? And in that example, if you're able to borrow and buy a whole extra property, that is a clear benefit to you. And so that could mean that you don't need to make, a lot of money out of it in the short term if it's allowing you to borrow more money and buy more property. Yeah. If that's what you want to do.
Yeah. And then some people say it's for asset protection. Can you explain that as well?
Yeah. So basically trust assets, or if someone is to get sued, then typically they get sued as a person. And so if you've got assets that are held inside a trust, then you don't own those assets personally. Those assets are actually legally owned by your trust. And so there is a level of protection that's there. It's not bulletproof though, because ultimately if you set up the trust and you put in money to start the trust, and then if you're also drawing a benefit from the trust,
it's still yours.
There is still a connection there. And so then it becomes like, who's got the better lawyer, who wants to spend the most money on legal battles and that sort of stuff.
I've heard trusts also, like they can still take from them if it's in family court. Is that true as well?
Generally family settlements. Yeah, look, I think that if you're really concerned about asset protection, if there's a real reason, and not concerned because, you went down a rabbit hole on TikTok or something, but like you have an occupation that has a high level of risk attached to it, or you've got a family situation that, is complicated and, volatile or whatever, probably worth seeking out some really quality advice from an asset protection specialist and working that into your plan.
Who's an asset protection specialist? Are they an accountant? Are they an advisor? Lawyer. So do you because you need an accountant to set it up for you, a financial advisor to give you financial advice on it, and a lawyer? Is that generally some of the experts who get involved?
Well, a lawyer can also set up a trust.
Oh, okay.
Yeah. And so in fact, lawyers were like the OGs of people that set up
the OG
entities. And it was like the accountants would just then register them and get the tax file number and that sort of stuff. It's only really in the last decade and a bit where it's like the legal documentation for these entities is now like, pressing buttons online as opposed to actually writing out trust deeds and those sorts of things. So a lawyer, it would be a person. You will need an accountant to do the tax returns, and typically you'll need them to register the tax file number and those sorts of things. An advisor you don't need, but obviously very good to have.
Yeah, especially if you've got that kind of money. If you're buying multiple properties and you've got extra money to invest, it might be worth investing in an advisor then.
Yeah, look, I think that using entities is quite a big deal. But like buying property in a trust, and I think it can be a great move. We have a lot of clients that do that, but there are implications, land tax implications, there's capital gains tax implications, depending on what sort of vehicle you're putting it into. And so if you're at that point where you feel like you're going to get, significant benefits out of using these entities, that's probably the same point where it's going to be worth you getting a sense check on your strategy and getting a proper financial plan, even if it's only to just validate what it is that you're thinking, maybe make sure you're not missing anything. And perhaps if you can't see a clear value stream from that advice moving forward, at least you've made sure that you're making the right move. Because I see some people and they have different entities with different sorts of assets and properties in particular. It's really complicated and really expensive to change things around after the fact. So it's like you probably want to get that right from the start.
Do it properly now. Yeah, having a company set up as well is already like an extra bit of a headache because I have to do my own tax return and the company's tax return. So if I have a trust as well, it's just like, it's so much going on. But
that's what the accountants are for, Tash.
Yes, but I like to know what's happening. I like to be involved. No, I'm not that annoying. I have a bookkeeper now, which has been fun, but I do like to understand stuff first.
Yeah.
And like what the best way is.
Well, I think that's important. And I think because you want to have confidence in what you're doing. And I think that applies with any area of your money. It's like if you don't understand it enough, it's great to have good professionals that you trust that know their stuff. But if you don't understand what's going on, that's where you can run into real trouble as well. So I think it's definitely the right approach for anyone to make sure you're asking your questions, you're dotting your I's. And
there's so many rules and little things that you just don't know about unless someone's telling you or you know where to look. Like with company stuff as well and registering for GST, like all of that stuff that you don't just know magically. It's quite interesting discovering it all.
100%. Yeah, there's a lot of complexity there. And like, if you're a money nerd, then it's sort of interesting. If you're not, it's probably not.
I like personal finance, but like company stuff has just been like not that exciting to me. I've just been like, wow, this is a whole other world and I just don't want to deal with it. But it's fine. I've got a good team now.
One step at a time.
Yes. Yeah. Thank you so much for joining us. This has been a very fun chat.
Yeah, great to be here.
You have your own podcast as well. What's that called?
Yeah, Mo Money Podcast. So it's on all the podcast platforms. You can check that out. We just did an episode with you. So
yes. Go find that one.
Check it out.
Amazing. Thank you.
Cheers, guys.
Thanks so much for joining us. If you found this episode helpful, please rate us 5 stars, write a review, or share with a friend. If you're new to investing, make sure to listen to our first 10 episodes. Follow us at Get Rich Slow Club or Tash at Tash Invests or me at Ana Cristina.
This show was brought to you by Natasha Etchman, who is an authorized representative 1299881 of Guideway Financial Services, AFSL 420367, and Perla, who is an authorized representative 1281540 of Sanlam Private Wealth, AFSL 337927. Knowledge is power, especially when it comes to investing. So make sure you check out our financial services guides and read the product disclosure statement and target market determination for any investments you're considering. See our show notes for more info.